how would you define the 1940s in today's terms? Because I think a lot of the controversy or going back and forth, a lot of the debate is just in semantics. It's not really in concepts or ideas. I mean, the 1940s, would you consider that transitory inflation or would you consider that secular inflation?
I would consider that secular inflation because you had a permanent increase in the broad money supply and a permanent increase in prices.
Okay.
And that doesn't mean you have a new permanent level of annual inflation, right? So that's the difference between, this was the point I was making earlier because this was kind of a kind of a question I knew would come up a lot and would confuse, especially a lot of people that don't follow finance closely,
Yeah.
is the difference between transitory and rate of change terms and transitory and absolute terms. So transitory and absolute terms would mean that say there's a specific supply bottleneck and prices soar. Let's say a gas line breaks and my state can't get gasoline. And so
Mm.
we have this huge spike in gas prices. It's very localized. And then eventually that gets fixed. And also, people get trucks and they bring over gasoline and people cut down their gasoline usage temporarily until that problem's resolved. And then prices go back down to kind of normalize with the nationwide average. That'd be an example of transfer in absolute terms. We eventually claw back all those price increases. And that can happen on a global scale if you have something like a specific industry gets disrupted. Let's say the biggest copper mine goes offline from a flood, for example. You have a temporary increase in copper prices until that's resolved. Same thing with autos or things like that. So that can happen. Now, what we saw in the 40s was the different kind of transfer inflation, which is you had this big permanent increase in prices, but the rate of that annual year-over-year inflation eventually stopped happening. You eventually went back down to low year-over-year inflation,
In the
but you didn't.
1950s, early 1950s, right
Yeah,
after
but
that
but yeah,
deflationary
but
period in the end of the 40s, right?
yeah, by the time you got to the 50s, and so you no longer had that structural inflation ongoing, but those prices were locked in stone. Across the board, you had broad permanent price increases as well as a broad permanent increase in the money supply as measured by M2 or M3 or different ways to measure it.
Mm.
And so people had more money in their bank account, things cost more, but then they stabilized at that higher level. And so that's why I wouldn't consider that overall to be transitory inflation.
Okay, so I think the takeaway there is people have to consider the supply side of the equation when considering how permanent or not permanent. I guess permanent isn't sustained. Let's say if inflation is going to be sustained, they've got to look at those potential supply shocks because it sounds like we had those in the 1940s, just like we're having those today.
Yeah, and I mean, in the 40s and also the 70s, part of the kind of the temporary halting of inflation, you see these wage and price controls kick in, right? And so if you look at both the 40s and the 70s, inflation was never a straight line. I always joke that if you imagine if Twitter existed in the 70s or the 40s, and you'd have like the inflationists and the deflationists, they'd be taking turns, kind of, declaring
Dunking
that they
on each other. Yeah.
exactly, because there were these periods where it's like, look at the prices going up, and then it's like, oh, look, now we have
Yeah.
negative 1% inflation. Oh, look, now
Yeah.
now it's
Yeah.
19%. And so I think we're gonna, now we're in 2020s, we're gonna see that happen in real time, where I think we're gonna have this kind of irregular environment, and there are gonna be periods of time where it looks like it's transitory, and then oh, maybe it's not, and then But I think we actually saw a little bit of a fake out there where inflation was leveling out for a period of time, and now it's being driven by other things. It's being driven by housing, and so we're kind of getting another leg up in inflation. But that's still kind of a smaller version. If we have, say, let's say there's congressional gridlock in late 2022 from an elections, and let's say fiscal spending dries up or at least slows down, decelerates. I think you could certainly have a period where inflation kind of levels off and goes down for a period of time, and then it comes down to what the response is going to be in that situation. So I think by no means is this going to be a smooth decade. It's not like this inflation is going to be right for 10 years. I think
Mhm.
it's kind of like, I think adding it all together and looking back from the end of the decade, I think we'll have said inflationists were generally right. That's my current base case. It's been my base case for a little while, but I think there will be individual years where they're not right at all.
Yeah. Yeah. And just for the average viewer out there, in the 1970s, you had this up and down and up and down and up and down, but you kind of had that up and down between, let's say, 5% and maybe 15%. And what made the 1940s different was those spikes up and down were between 19% and -3.
Yeah.
So kind of a different range there. So without getting into the plumbing of why it happened, just kind of the headline numbers. That's what you're expecting, and kind of that's what I would expect as well. And it's really based on, kind of the government. I said in a discussion I had at Mark Moss's event over the weekend that you've just, unfortunately, you have to start answering economic questions by answering political questions first.
Yeah, I mean, and you have to do it on the global scale as well, right?
Yeah,
So the United States used to be the major global driver, and it's still one of the biggest. But you also have to look at China and Europe to varying degrees. And so, basically, certainly China can affect iron market, for example. Uh, you know, all these different countries based on their fiscal policies and which things they let happen, and the timings of which they let them happen influence these things. So I think when things start showing up on popular financial magazine covers is when you have to start really considering, okay, this might still be right in the longer term, but it's not going to be a straight line of the way there. Once everybody is on one side of the boat, turns over, shakes out some of them, and it kind of then it goes through another cycle. And I think that's how we have to approach it.
yeah, and everyone's on the inflation boat right now. So, to your point, I wouldn't be surprised if 2022, 2023, we had a CPI print, and even though it's kind of bogus, but that CPI print go back down to 2% and shock everyone, and then the very next year, based on government spending or another supply shock that's created by government distortions in the economy, it goes right back up to 8% or 7%.
Yeah, at the current time, I say we have reasonable transparency out to about 2 quarters. So we pretty much know that housing and rent inflation are probably going to keep the number kind of sticky for a while,
Right.
as officially measured. So if you look at, right, they don't directly include housing prices and CPI anymore. Um, but they include a proxy of owner's equivalent rent, which is kind of an understated and smoother way to measure it. And if you you also track, say, official CPI rent increases compared to what actual rents are going up as. If you look at, for example, Invitation Homes, I think they're the biggest single family homeowner in the U.S.
Mhm.
They had like something like 60% rent increases for their new tenants and something like, what was it, 7% for their existing tenants. So it averaged to be like 11% rent increases, and we
Right.
haven't seen that fully in the rent CPI yet, and we haven't seen owners equivalent rent kind of keep up in any way with overall housing price increases. And so it looks like it's based on the momentum of what's happening there in CPI. It looks like we still have at least another quarter or two of those kind of keeping the headline CPI number sticky. But yeah, once we get into mid 2022, that's going to depend on a couple different factors. What are the fiscal situations in the United States, Europe, and China, and also what's happening with some of the supply chains, right there. So that's what I would start to say, that maybe it won't be a straight line, in around that time, but I could certainly update that view based on what happens between now and then.